Today's videos dive deep into the pressing issues of the housing market and real estate investments. Home builder inventories have spiked, mirroring the 2008 crash. Is a colossal market downturn imminent? For potential investors, the debate between paying off student debt or diving into real estate for higher returns gets intense. Stay informed as experts break down these critical trends and reveal opportunities that could change the game. Don't miss these crucial insights. Like and subscribe for more financial analysis. Today, on Real Estate in Review, we will summarize the following videos. From Reventure Consulting, we have home builder inventory spikes to highest level since 2008. Colossal crash coming. From BiggerPockets, we have pay off student loans or invest in real estate, which makes you richer. From Real Estate Mindset, we have Texas new home fire sale, we found them. From Real Estate Mindset, we have adjustable mortgages bankrupting homeowners. Welcome back to Reventure Consulting, where we dive deep into the U.S. housing market and beyond. Today, our host Nick Gurley is dropping some major news about home builder inventory levels that have hit their highest since 2008. And guess what? There might be a colossal crash just around the corner. Buckle up, folks. Nick sounds the alarm on a skyrocketing home builder inventory, likening it to 6 previous historical spikes that ushered in housing crashes and recessions. According to Nick, we're on the brink of significant economic downturn, particularly felt in hot markets like the South, with specific focus on Florida and Texas. The message? A major housing market crash could be imminent. Here are the key points discussed by Nick Gurley. Skyrocketing builder inventory. Home builder inventory has surged to 9.3 months of supply, one of the highest rates in history. Citing the U.S. Census Bureau and Reuters, Nick mentions we're at a 16-year high in builder inventory. This trend is reminiscent of the 2006 housing bubble, particularly pronounced in the South. Immediate economic impacts: expect layoffs in construction due to decreased future building permits. Florida's market is already experiencing a downturn with skyrocketing inventory levels and price cuts. Regional variations and trends. Florida and Texas are leading the downturn, with inventory levels and price cuts spiking. Meanwhile, other areas like the Northeast and Midwest still show low inventory and positive price forecasts. The heat and human factor. Nick shares a personal anecdote about the blistering Florida heat, hinting at how it might further impact migration and market dynamics. Nick Gurley made the following predictions. Economic downturn. Nick anticipates a recession sliding into place over the next 6 to 12 months, correlating strongly with the builder inventory spike. The excess supply, intersecting with declining demand, could initiate deflationary forces across sectors. Housing market slow burn. Nick emphasizes that housing downturns take time, referencing historical precedents where housing prices took up to 5 years to bottom out. Localized impact. Market conditions will vary regionally, heavily dependent on local inventory and demand trends. Nick concludes by urging buyers, investors, and sellers to closely monitor their local market trends and data. Understanding local inventory and price dynamics can provide better insight into the broader market movement. He hints at potential future deflationary pressures and a recession, telling viewers to stay savvy and informed. Head to reventure.app for more data-driven insights to navigate these turbulent times in the housing market. Until next time, stay cool and keep your eyes on the numbers. Hey everyone, welcome to the BiggerPockets Real Estate Podcast, where we're breaking down all things real estate to help you achieve financial independence. In today's episode, Dave Meyer brings on investor Tom Keating. Despite juggling hefty student loan debt, Tom has successfully navigated the real estate waters, and he's here to share his journey and a cool system he's developed for market selection. The core thesis of this episode revolves around whether you should pay off student loans before investing in real estate. Tom Keating argues that, in many cases, investing in real estate can yield higher returns than paying off low-interest debt. Using his personal story and financial savvy, Tom breaks down why leveraging debt might just be the smarter financial move. Here are the key points discussed by Tom Keating: personal story and early entrepreneurship. Tom's first entrepreneurial venture involved selling golf balls he found around a local golf course. In college, he tried his hand at a meat delivery business, which failed but taught him valuable lessons. Transition to real estate. After college, Tom worked in finance at a bank, which gave him a strong understanding of debt and loans. Tom stumbled upon Brandon Turner's book on rental property investing, which led him to the BiggerPockets podcast. Within 3 months, Tom bought his first property. Managing debt versus real estate investment. Tom still carries his student loan debt because it has a low interest rate of around 4 to 5%. He emphasizes that when the cash-on-cash return of a real estate investment, 10% plus, is higher than the interest rate on your debt, investing could be the better financial decision. Tom encourages people to evaluate their own debt and potential investment returns. Diversification and portfolio management. Tom's portfolio includes small multifamily properties in New York, Florida, and North Carolina. He invests in different asset classes such as self-storage and even campgrounds. Tom advises focusing on one market to become an expert before diversifying. Selecting markets and properties. Tom uses an overlay map to pinpoint areas with significant development and transportation improvements, indicators that property values will rise. He recommends driving through neighborhoods to get a feel for the area and find hidden gems. Tom Keating made the following predictions. Market appreciation based on development. Tom anticipates that properties in areas with new development, such as Charlotte, will appreciate significantly. He bases this on patterns observed in other southeastern markets. Future passive income and mobility. Tom plans to scale his business to be more passive, allowing him to travel or be location independent. Tom Keating underscores the importance of evaluating the cost of debt versus the potential return on real estate investments. He shares actionable insights into market selection and portfolio diversification, encouraging listeners to be strategic and informed. For those bogged down by student loans, Tom's journey offers a compelling argument for stepping into the real estate market smartly and calculatedly. Welcome back to Real Estate Mindset. In today's video, our lively host Eric Nelson embarks on an investigation into potential foreclosure hotspots, focusing on a Dr. Horton new home community called Silverthorne in Conroe, Texas. Eric ventures into the suburban wilderness, evaluating if Silverthorne could be the next foreclosure hotspot, benefiting buyers seeking deals of their dreams. Given the location in the middle of nowhere and fierce competition, he aims to track and analyze local real estate dynamics, hoping to uncover future price cuts and potential buyers' market conditions. Here are the key points discussed by Eric Nelson. Location and initial impressions. Silverthorne is located in Conroe, Texas, accessible through a long drive from downtown Houston. Despite its alluring description, it sits surrounded by other competitive subdivisions with significant price cuts. During his visit, Eric observed minimal construction activity and described the site as a ghost town. Market context and competition. Silverthorne is underscored by 32 surrounding communities with 1,167 homes competing in the same market. Competitor communities like Brightland Homes, Toll Brothers, and Legend Homes offered significant price cuts to entice buyers. Brightland Homes, prices range from $254 to $319, offering 10 Kela discounts. Toll Brothers, discounting homes by nearly 120 Kela, highlighting luxurious features. Legend Homes, prices as low as $224 with approximately 15 Ken in incentives. Construction observations. Eric observed Silverthorne's readiness with utilities and streets in place, but a notable lack of construction crews. In contrast, competitor communities had more active construction, displaying various sold signs and ongoing development. Predictions and market prospects. Eric anticipates that Silverthorne might struggle to sell new homes without dropping prices substantially. Given the high competition and market saturation, new construction areas like Silverthorne bear considerable market risk. Eric Nelson made the following predictions. Price drops in Silverthorne. Eric predicts more significant price cuts may be on the horizon for Silverthorne due to the intense competition and the current lack of construction activity. Potential buyers market. The current and upcoming market trends could soon favor buyers, allowing them to secure homes at substantially reduced prices. In wrapping up, Eric recollects the potential of Silverthorne becoming a foreclosure hotspot amid intense competition and market saturation. He emphasizes the importance of real estate buyers staying patient, disciplined, and well-informed about the quality and pricing of new homes. If you're on the prowl for great deals, keep your eyes on new construction hotspots like Silverthorne. Dive into the market, boots on the ground, and remember, it's all about understanding the value to make the best out of your investment. Welcome to another eye-popping episode of Real Estate Mindset. Today, our host Eric Nelson dives deep into the ticking time bomb that could be affecting millions of homeowners: adjustable rate mortgages. We'll explore why these financial instruments are creating havoc and discuss the qualifications and unique perspective David Weum of eLending brings to this critical topic. The core thesis of this episode emphasizes how the soaring unaffordability of both home prices and interest rates has led many recent homeowners to resort to adjustable rate mortgages, putting their financial stability at grave risk. David Weum stresses that secondary lenders are shying away from these risky loans, leading to rising household expenses and potential financial catastrophes for these homeowners. Here are the key points discussed by David Weum: adjustable rate mortgages, ARMs. Many homeowners, especially recent ones, are turning to ARMs to combat high prices and interest rates, but often without fully understanding the risks involved. These homeowners are now facing significant increases in payments, not just from mortgage adjustments, but also soaring property taxes and insurance. Impact on homeowners. Many are being forced to sell their homes due to unexpected financial strains, but find themselves upside down, owing more on the mortgage than the house's market value. Options for these distressed homeowners include short sales, loan modifications, or foreclosures, all of which significantly damage their financial health and purchasing power, hollowing out home ownership dream. High interest rates and soaring home prices have made homeownership increasingly unaffordable, especially for first-time buyers and younger generations, leading to lifestyle downgrades and doom spending. David Weum made the following predictions. Market correction. A significant correction is anticipated in home prices as more families are unable to sustain their mortgage payments and inventory increases. This could create buying opportunities for those who have remained patient and financially conservative. Temporary buy-downs. Temporary buy-downs have surged, but many of these are set to adjust by 2025, further increasing the financial burden on homeowners. This will exacerbate the market distress with skyrocketing property taxes and adjustment rates converging. Eric Nelson and David Weum conclude with a call for caution among potential homebuyers. They stress the importance of understanding the full scope of financial obligations, emphasizing how critical it is to avoid risky loans like adjustable rate mortgages. Their ultimate advice: be prudent, stay informed, and increase your purchasing power by improving credit scores, income stability, and savings. If you're out there navigating this tumultuous real estate market, remember, patient turtles always cross the finish line. Each video presented compelling yet contrasting views on the housing and real estate markets. Nick Gurley from Reventure Consulting warns about an impending market crash due to sky-high builder inventories and regional downturns. Tom Keating from BiggerPockets argues for leveraging debt through real estate investments rather than paying off student loans, citing higher returns. Eric Nelson from Real Estate Mindset pinpoints potential foreclosure hotspots and scrutinizes the risks of adjustable rate mortgages. Agreeing on the necessity of market vigilance, the experts diverge on strategies for leveraging current economic conditions. Stay tuned and savvy. Thanks for watching Real Estate in Review for July 7th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.